So in June, we entered the first bear market since early 2020 when the COVID pandemic began. Bear markets are signified typically by a 20% decline from the market peak. Right now, the S&P 500 is down right around 20% as we speak. It's not that uncommon, first and foremost, to have a 20% decline. Typically, we see them, once every 3 years on average. What's a bit unique right now in the markets, I'd say, Jonathan, is that diversification is really not helping a lot this year. We've got the bond markets down roughly 12%, and then, like I just said, equities down about 20%. That's a bit unique, and we've got the inflation dynamic at play, but also some recessionary concerns potentially in the future.
Yeah, it can feel unique because diversification, as Ryan said, it just doesn't feel like it's working yet. In some ways it's unique, but in other ways this is kind of how bear markets tend to start. The early phase of a bear market can be just a take no prisoners type of approach in which the high degree of uncertainty in the environment means that sometimes stocks and bonds can react to different things at the same time, and that diversification doesn't quite work. They link up together. As certainty emerges, whether that certainty is good news or bad news, we start to see diversification historically fall back in line. An example, if we end up continuing down this road to potential recession in the economy, which I'm sure you're reading about and seeing, the certainty that might emerge from that, we could see actually the fixed income or the bond part of the market start to get some more inflows and get some more support.
Yeah, and I think to that point, we saw that in 2008. We also saw that during the COVID-19 pandemic. I think for us as advisors, we talk a lot about the opportunity that these type of markets present for us and our clients is to really lean into the long-term financial plan and the long-term vision. Again, we tend not to invest with a 10-month horizon in mind. We're looking typically 10, 20, 30 plus years, with our clients' money. And that's kind of the same messaging that we're delivering to them is to stay the course as long as the plans continue to hold up, withdrawal rates look to be in line, and sequence of return risk hasn't impacted the clients in too negatively of a manner.
Yeah. And just the last thing that I'd add for everybody is that there is a reason, there's a rationale as to why we meet with our clients regularly, and the reason for that is so that we don't go years in between talking and then end up in a market like this and try to play catch up.